Welcome, everyone. Hi, it's...
I can see everyone. Sean and Sheena. I feel as though I'm on Romper Room. You know what they say? I can see Sean and I can see Sheena. There's Bansel.
It's 7 o'clock on Wednesday, the 5th of March, 2025. And we're here just waiting for more people to join us. We're delighted that so many people have shown an interest in this topic. I might just mute everyone for the moment, except myself. This topic is something that's just recently drawn focus in my circles because of some things that have happened with people around me and some stories I've heard. And then we're delighted to have continued our long-standing relationship with Grant Abbott. And he's going to be hosting this tonight. We'll just wait a few minutes until more people come in. We're expecting some 40 or more. I'll also introduce Cass Smith, who's our Freedom Financial Solutions FFS founder. Cass has known Grant for quite some time. So maybe, Cass, do you want to share a few thoughts?
Yeah, thanks, Mary Jane. Yeah, I don't even know how long I've known Grant. It must be almost 10 years, I would say.
Yeah, exactly.
From the beginning days of my small accountancy firm until it grew to a much larger accountancy firm, and then we switched to Freedom Financial. So Grant has been the provider of our SMSF documentation and our company and trust documentation, so for 10 years plus. So that's good to know that we've had a long relationship. This isn't just a fly by the night, jump on in and have a chat. I've known Grant for a long time, and then where we are expanding is into the estate planning side of things. Estate planning has always been a morbid fascination for myself. I laugh and I tell the story about being 20 years old and in university and learning about wills and testamentary trust for the first time, and rushing home to my mother, my grandmother was, getting very old, and saying, Mum, we need a testamentary trust for Nan. She didn't listen to me, but anyway, fast forward 30 years and I have made sure that my own mother has a testamentary trust for my family in her will. Even though she didn't want it, I just I made her do it. So that's where we're expanding into this area. It's something I have wanted to do, estate planning, for quite some time. And but I have just run out of time and taking a bit of time out for myself. So it made sense to have Grant's team just step in there and provide the service, because I think since COVID, everybody's woken up a little bit more to mortality and planning, and I'm sitting here about to experience my first cyclone. So estate planning is just something we should all have in the back of our mind, even if it's just enough as having a good will with testamentary trust in the background. Some of you might need even more than that if you've got complicated families, but really, really important. But I won't steal Grant's thunder because that's what he's going to talk about. I'll hand over to him. I will just be here if any accounting type questions come up.
Beautiful. So do you want me to take it away, Mary Jane?
Yes, please.
Perfect. Oh, thanks for this. I almost had this cancelled as well because I'm up on the Sunshine Coast, so I was in Melbourne all this week. In fact, I was supposed to do a presentation this morning in Melbourne to a whole lot of accountants and also SAPEPA advisors. SAPEPA's on the chair of the Succession Asset Protection Estate Planning Advisors Association. So, but when I saw what was going on, and my wife, love her dearly. She's from America, but Americans tend to have she's a prepper, so it's always, everything's going to be the worst is the worst. So we prep for anything. I can tell you that we can virtually live in here in a house for almost 3 weeks, which is good. So we'll wait and see. But it doesn't look as though, well, who knows? It doesn't look as though Sunshine Coast is going to be hit that hard. I think it's going to be down the Gold Coast and Byron Bay, which is, for anyone in the Northern Rivers, that's the last thing that they need, is another deluge there. So just a bit on my background, and I'm going to take you through lots and lots of stuff tonight. So I'll go for around about 50 minutes. There's a lot of strategies. The good thing about it is this is recorded. Couple of things. I won't spend much time. So this is a book I wrote in 2018. It's being updated very shortly. So that's the Guru's Guide to Self-Managed Super Funds. So that's sort of where I started a lot of my work. I was a tax lawyer and then moved into superannuation and really started the ball rolling in self-managed superannuation funds, which they're done well. So there's now $1 trillion. I think it's 1.04 trillion dollars sitting inside self-managed superannuation funds. So if you're not a self-managed super fund, then I'd strongly suggest you get, if you've got money in retail or super, industry super, you're in completely wrong. You don't understand the strategy game. There's a difference. If you want to build wealth quickly and for a long-term perspective, self-managed super funds the one for you. If you just want to let it sit aside and do nothing with it, pay a lot of fees to people who just follow the ASX, then a retail industry fund's for you. The other one is the book that came out just before Christmas. It's almost impossible to get now. I think there's only around I think we've got about 30 copies left. So we're going to the second edition already. So I've just been through and had a look at it again, and even I was surprised at. It's funny because it took me a year to write, but I was even surprised about how the depth and a lot of the information around in there. So it's about family wealth protection. More importantly, estate planning is probably the wrong name for things, mainly because we have more than 50%, depending on the state, but around about 50% of all wills are contested. It's even getting so much, so we've got a legal firm, LY Legal, and we're even seeing children contesting their parents before they even pass away, trying to take guardianship, trying to access money. So it's a whole new ball game, and the reason that is the case is that there's $10 trillion in terms of businesses, in terms of properties sitting at trusts, etc., and also monies that are sitting in individuals' hands and superannuation, which is going to pass hands over the next 20, 25 years. So for a lawyer, that's a bonanza. So that I'm like the white knight, so I try and make sure that everything's protected. And you can see here's the picture of looking for you building a castle with a huge moat around it, full of alligators and piranhas and all that to keep the hordes out. It's not necessarily yourselves that are the issue. So I have a lot of parents who been in good relationships for married 20 or 30 years, but it's the next generation which is the problem. In fact, I only dealt with a client yesterday, and they were saying that the grandparents passed away and gave all these assets to the grandchildren, which was fantastic, until one of them got divorced, and then that was the end of that asset. So it was virtually split. Divorce, unless you're using a trust style, and that's what I'll talk around today, unless you're using a trust style document to really shield or provide ring fence around your assets, it's virtually open slather to the tax office, creditors, family law, absolutely. And then when you pass away, family provisions. It's even being used by children now that, parents have, particularly we do a lot with farming families, where, dad and mum said, look, when we turn 65 or 70, we'll give you the farm. And of course they don't, because they still need the cash flow, but then the kids are actually able to take a claim against them under promissory estoppel. So what our job is to look at all the ways and the means that your money can be attacked. I've got no, I've got no idea. I wouldn't be here if I knew how to make millions of dollars. I had been through a couple of divorces, so I certainly know the vicissitudes of going through a divorce. It's very, very expensive, and very, very painful. I wouldn't recommend it on anyone. I had dealt with a client the other day, and they're in their 5th year of the divorce at the moment. So, and they're up to $300,000 in legal fees. So it can be a very nasty spot. And then the other side of the equation is that if you do come out of a divorce, essentially, what to, how to protect yourself. So we've got a lot of strategies around that. I'll talk about that. We've even got on our legal team, we've even got one of our teams, a girl who specialises in building family wealth protection for divorcee or divorced females, which is great. So let me go in, and just going to go through some slides and cover some of the concepts that are basically from this book. So again, if you can get a copy, you can get it at grantabbott.com, or certainly Mary Jane will shoot some stuff out. But as I said, there's not that many copies left, but you can get it on Kindle, and we'll be updating the Kindle very shortly. So again, it's a completely different philosophy. The key areas, there's 14 chapters in the book, or 12 chapters. So no, there's 12 chapters in the book, 14 chapters in the SMSF book. And essentially what we want to do there is start off with the start, which is going to be succession. What I want to do is, so there's the moat and the castle. We won't go through that. I won't go through contributions. So small business owners are basically anyone as well. Unfortunately, Australia has the most lawyers per capita of any place in Australia. The worst one is in Sydney, in New South Wales. One of the areas that I work quite heavily in, apart from family wealth protection, is artificial intelligence, particularly building solutions around self-managed super funds, tax, and also the law as well. I've also got a business that basically builds legal documents and is starting to use AI tools. So what we normally go to a lot of lawyers before is slowly getting decapitated, and that work is going to be pushed up into litigation. So you're going to find more and more people going to be sued, particularly when you have that no win, no fee lawyers there. So if you live in a state that's got, $1 million or $2 million or $3 million, and you've got an estranged child, or an ex-spouse, if you're in New South Wales, even carers can make a claim on your estate. And the process there is that when you pass away, before you get your probate and your will, if you actually ask me, I think wills are like the third line of defence that you need to have in terms of family wealth protection. But you get down to the stage of being in a position that the probate may happen, and then depending on the state, but in New South Wales, from a year from the date of death, you can make a claim on the estate. So that includes ex-spouses. There has been cases, Kelly's case, where they went back 30 years to find an ex-wife who was able to make a successful claim on the estate. New South Wales is probably the worst out of all the states. They've even had a case, because normally what happens for most couples is they hold the assets jointly, which is problematic in the end. I'll explain why. But in this one case, Cowp and Cowp, which was in 2021, they'd been in mum and dad had been in family property for 57 years. They had a stepson who was in around about 60, had an accident. Dad had passed away. This was the stepson. and all the assets went to his wife for 57 years because they're all joint. So that was shares, cash, and also the family home, which was, believe it or not, down in the ACT. What happened there is that effectively the court said that, you know, dad should have provided for the stepson who was sick, and so stepmum had to sell the property and downsize. So the court said, hold on, you've got enough cash and dividends to live on. He needs $700,000. So out of $1.9 million estate, he got $700,000, which was also hard because there was another 4 children who were going to, you know, be looked after mum's will, but, you know, they were obviously going to be cut out of it, you know, quite a significant amount. The assets in our own name, look, it sounds nice. So what my preference is, I'm going to show you a little strategy. There's quite a significant benefit of having tax assets in our own name. So having a family home in our own name, and with that one is we get the principal place of residence exemption. So that's a capital gains tax exemption. I did promise to tell you that if you've got assets in joint names, which is fine, the problem about it though is when one passes, the asset goes wholly over to the other spouse. Now, if it's in their name and they get into another relationship, then the problem there is the wealth is built up into that property. If they then get divorced, then effectively that property is up for grabs. So I'm going to show you a strategy called the protector very shortly. One of the elements out of this is, because we work very closely with Mary Jane and Cass, is if you like, after this presentation, and particularly for those of you who've read the book, if you'd like to come and grab a meeting with me, like 45 minutes, 50 minutes, Mary Jane builds a really good background on you, particularly around your family, because what I want to do is I want to go and start to have a look at weaknesses, and then how we can build strategies around those weaknesses. I've come up with around about 50 strategies. There's easily 30 or 40 sitting in the book there as well. I think chapter 11 is my top 10 strategies. For negative gearing, believe it or not, so I think we all know what negative gearing is. We go and save up money for a property, and essentially we put a deposit down. It's a lot harder to get 5 and 10% deposits. These days we need to get 20% deposit. The bank lends us the money, we get the rent in, and then we can take off any interest expense as a tax deduction, capital allowances if it's a relatively new property, and depreciation for any fixtures and fittings in the property. So quite often we end up in a negative position. So we've got losses on that property, which we can offset against our salary and wage income, business income, etc. So negative gearing has been a great strategy over time, but it's a very weak strategy for a couple of reasons. First off, in fact, there's 3 reasons. First off is the assets that are in our own name in order to get the tax benefits. As a consequence of that, again, there's that big target on our back. Whether the tax office is going through, if someone falls on the property, our insurance doesn't cover it, then sayonara to that property. The other side of the equation is that at some point in time, the property, when you want it, because essentially no one buys property to put the kids through school because it's negatively geared. When you retire, the old strategy, which is I call pre-2000s, was to have like 3, 4, 5 properties when you retired, and essentially they were providing you with rental income, and there wasn't that much many mortgages on it. The danger about that though is one is you've got that big target on your back, but you've also got potentially a large capital gain that if you sold it, you're up for capital gains tax. and also the rental income is going to be fully accessible to you or taxable to you. So it's like the worst of all worlds, really, for it. Best place, believe it or not, to negatively gear is inside a self-managed super fund. I'm not going to have really much time, won't have time in this presentation to go through it. But essentially, rather than having the deposit being paid out of after-tax money as you would ordinarily, the goal there is to get tax-deductible contributions in to pay for your deposit. And then when you turn 60 or 65, the way we structure it, when the mortgage is paid off, effectively we have a situation that there's no tax in the fund on the rent, and there's also no tax when it's paid out to you. And if you sell the property, there's also no capital gains tax. So negatively gearing outside was a good strategy pre-2000s, but really since that time, it's far better to negatively gear inside a self-managed super fund. Plus, the benefits there is that any equity that you have inside the self-managed super fund essentially is protected from your trustee in bankruptcy. So it sort of takes the target off. I could go, I think I've had a chat before with Mary Jane and said, look, if you're interested in, if FFS is interested in doing a more SMSF strategy style seminar, particularly before 30 June, I'll really show you how to make these things sing. And if you got your money in a retail or industry fund, I'm sure you'll, it's worthwhile coming having a look at what you can really do with it. The other one, the typical one to protect particularly if you're in a business, is to have the assets in the spouse's name, which is pretty problematic because if you get divorced and you haven't got any assets in your own name, how are you going to pay for the lawyers? That's a drama. The will or testamentary trust, there's a lot of stuff happens before the testamentary trust or the will. As I said, a will can be almost nonsensical these days. Over in West Australia, I always use and you'll see this in the book, the Miller and Taylor case, $600,000 estate made up of really one property, and many of you would have a larger estate than that. He had a will from 13 years ago where it was split between his son and daughter, but he'd been involved with Angela Miller for on and off again for 12 years. She made a claim on the estate, and the Supreme Court awarded her 40%. So you'd say, well, that's pretty good. She's done well. $600,000 of 40% of that, that's $240,000. But the problem with that is by the time she got that award, her legal fees were already $199,000. So she ended up with $41,000, and the children were exactly the same. Of that estate, $540,000 was paid in legal fees. So as I said, that $10 trillion is going to turn over from baby boomers. Best place for it. I'll come back and have a look at this protector. I just want to show you some let me just show you this. So I just want to give you an idea of what modern trust law is, or modern trust strategies. Trusts have been around, believe it or not, the first trust was way back in Roman times, but they became very popular in the 12th century when the knights in England went and did their big crusades. So they go away, but most knights had property that was gifted to them by the king. In those days, there was no such queen in those days, by the king. But because they were going away on a crusade, there was no, they had no idea. The chances of them coming back are pretty slim. So what they did is they used to put the legal title in the name of, a brother, a friend, or whatever. And then when they came back, the problem was there'd be a whole range of disputes, because under common law, they transfer the title to their best friend or another knight, and then they had no right to title because the the other person had the title. So out of that came what we call the law of equity. And then that first held that property was actually being held on trust for the returning knight and the crusader by the relevant person in there. And that's really been the case since the 12th century. They were put in place as well in the 16th century, I think, or I'm not sure when Henry VIII was around, but he used to charge a tax on the death of a landholder. They charge a tax, which they do now. It's called death benefits tax over in the UK and America. We don't have it in Australia except on superannuation. But what they came up with is holding the property in a trust, effectively got around that death benefits tax. So that's the case. So the other one that's really fairly important is an 18th century decision, Saunders and Vautier, and that's been tested so many times. But essentially, there it was held, and continues to be held that a beneficiary has no right or entitlement to any assets sitting inside that trust. And that's why that if you get sued and you've got assets sitting in a trust, effectively your creditors, whether it's a tax office, whether it's a business creditor or whatever, can't access those assets. Same thing as if you've got your assets sitting in a family protection trust, then essentially also on passing, remember we talked about family provision claims apply in relation to estate assets. So if we've got, as I said, it's very hard. We might have, if we've put some properties or we put cash or we put jewelry or whatever inside the family protection trust, it's protected against any family provision claim. So it's a very strong vehicle. The key to setting it up, because the majority, and some of you may have what we call family discretionary trusts for your businesses, or an accountant has set them up or whatever. The problem about them is they've actually been set up for tax purposes and not family wealth protection. So a family protection trust really needs to be built for multi-generation. And that's why in the book, or a good Pepper advisor, is that we build family wealth protection for your bloodline only for generations to come. So you're not necessarily thinking about yourself unless you've been divorced or whatever. Blended families, if you've got a blended family, look, you've got to come and see me straight away, because that's, if you heard about that stepson that I talked about, that's guaranteed. If a no-win fee lawyer gets that, it's like it's all over. So the Family Protection Trust, we have on the left what we call the Family Protection Appointors. They're effectively the kings and the queens of the trust. They don't really do much, but what they do is they've got the power to remove the trustee. So like any trust, you need someone to manage the business, run the administration, do all of that sort of stuff. So we have a trustee for it, and that's the typical party. So we've got an appointor, we have the trustee, and then we have the beneficiaries. So the issue there, though, is we don't, obviously, if we're trying to do family wealth protection, we're never going to be a trustee as an individual. It doesn't make sense. Because, again, if you're an individual anywhere, you've got effectively a big target on your back. So with a family protection appointor, they're really the ones that, like if the trustee does something wrong, then effectively they're fired, and they can put in someone else who's more compliant. So the family protection appointor is really the king or the queen of that trust, and quite often it's going to be a husband and wife. If it's a second marriage, it might just be one person there as protection. So what it means is that, though, when both pass away, we need to have the next family protection appointor in line. And same way, if you've got a family protection appointor, the tax office is suing you for a debt, then you might want to resign your position as the family protection appointor and let it immediately drop down to the next family protection appointor. So when you come and have a meeting with me, the first thing I'd really like to see is a multi-generational approach of who can be really the kings and the queens. I've modelled this on, as you can see, I'm not a royalist by any stretch of the imagination, but I am enamoured by the fact that huge amounts of wealth. I think there's 30 billion pounds of wealth and property and all that can transfer between generations of kings and queens in England. There's never any litigation. There's nothing along the lines. I think that's fairly important. So again, we'll talk about that line of succession. With the trustee company, you can be like the director. It's not a huge issue. It's important because it's, again, more managerial. The big thing here is we get the strong line of succession. When we have our children in here, so I've got here C1, C2, C3, so there's 3 children there. When that money passes to them, and this is the good thing, as I said, with your personal estate, you pass away, there's probate, and then the first year, the executor can't really pay out money at all. And I'm sure many of you either in your families or know friends and families who've had their estate challenged or their parents or whatever. So it can be a nasty situation. I've seen some go for 10 or 20 years. Essentially, with that one is that the money gets locked away until there's, there is no, that 12 months, there's no family provision. Where you've got a trust, the money just carries on. So even though the family protection appointer dies, what happens is the next family protection appointer comes in, and then we have a look at the beneficiaries. So in the trust, it's going to be we don't have any named beneficiaries. And the reason that is that it's extremely dangerous. Modern trust law these days, as I said, they're coming up with screwy ways all the time to try and attack wealth. There's been a couple of cases where children who've been beneficiaries in here, where parents haven't made distributions to them, or haven't taken even into account their financial circumstances of making distributions, they've been able to remove their parents as trustee and also appointors, and get a court-appointed trustee. So what we do is we just simply say the person who is the family protection appointor, so we've got a little table, that line of succession, the same thing as the British royal family. You've got Charles, William, George, is it Lilibet? Anyway, keeps on going down. Was it Charlotte? I keep on forgetting. But you've got a long line list there. And then what will happen is automatically, if one of you passes, if you're in a relationship, the next spouse comes in if you want them to. If you're in a second marriage, you may not want them to. It might just be for the children. And then what will happen there is what we do is we split the trust for the next generation. The reason we do that is that the Commissioner issued a ruling. We got a ruling in 2019 that basically said that when you split from here to here, there's no capital gains tax or stamp duty. So each of the children have their own what we call subtrust. They're in control of their subtrust when it comes around to investments if they want, when it comes around to distributing, because they can also distribute to their children as well, because this is their own little fiefdom that sits in there. The benefit of having them all in there is essentially there's no way that family law, which is fairly, can ravage trusts, not so much if they're set up properly, but family law can't go in and it's not even, if you have a look at the recent family law cases, the family lawyers can't even get access to the trustee, which is pretty important. So splits on death with no capital gains tax duty. Each child becomes a director of the trustee company, but that director is the only one who can make a decision around C1. So C2 and C3, who might be directors up here, they can't gang up and say, oh, hold on, you have to do this, because it doesn't make sense, because you know what kids are like. They tend to disagree. So over time, we've made sure that it's as least disagreeable as possible. Now, for business owners, and so what I'm going to do now is I'm just going to talk business owners, because this is typically what you would see from a business perspective. You'd have what you've got as this is an ideal where we'd move it to. But ideally, you've got if you have an existing family trust, you may be operating the business through the family trust, or you might have an operations company. You might be truck position, or might be a lawyer or an accountant or whatever, and the shares might be held by the trust, or you might be running that business through the trust. Now, that's set up for tax purposes, which is quite useful. Now, again, as I said before, we still want all the tax benefits, which we do get in relation to that trust. But what we've got to do is we need to basically put in all these other things: the line of succession, the children, the bloodline beneficiaries. Now, when we do this we'll have an operations company here or an operations there. What we want to do is the same way that the Crown has all their, crown jewels and all the properties in a Crown estate, which is like a trust style structure for the transposition of assets between generations of kings and queens. What we want to do is, if we get attacked, because quite often, if there's a trustee in bankruptcy or liquidation or ASIC or the ACCC or anyone is going to attack these entities, they're actually going to attack the operations company. So what we want to do is keep that lean and mean. So what I do is we pull out from here. Just go down. We pull out from here out of the operations IP, which might be your key assets, your business process, your marketing processes, your brand names, logos, and all that, and we put them here because they're your crown jewels. They're the stuff that really makes your business, how the business goes around. So that if this is attacked, we can wind this up and then we can start again because your crown jewels are protected. We like to split those, but that's a little bit more of an advanced strategy. But again, this is the benefit of when you come along to have a meeting with me, is that I'll have a look and then I'll make all these suggestions for you. But have a look in the book; it's worthwhile. The other one that you have is, again, a bucket company. I won't go into that, but there's other strategies we have with this as well. There's another little one that we've got, which is a bit of an add-on for these family protection trusts, is that you might have a spouse who's not financially savvy in here, or you might have one of the children who might be an alcoholic or a drug addict. In fact, we've put in positions in here that, they can't get any money or distributions out of here unless there's sobriety tests. There's a whole lot of stuff you can do. C3 might be, for example, a child who's got a disability or NDIS or ADHD or autism, very prone to spend. It's just part of their position in life. So again, we might need to protect it. And likewise, it might be that, you've got three parties in there, and they can each do their own thing, but we might have in place a guardian, which might be Cass or might be Mary Jane, who sits on the side, or myself, who sits on the side and, gets engaged once every 3 months to, start helping these people make a decision. Same thing definitely is the case. So if you've got minor children, quite often, if mum and dad both pass away, the FPA2 here might be a brother or a sister or a mother. So again, we want to have a guardian there who's helping them through the process, but more so overseeing them, because we want to make sure it's all straight up. So that's, if we've got a existing family protection trust, then what I do is I always move to this style. If there's a business in there, we may. It doesn't necessarily mean we're always going to do that, but I always want to protect the crown jewels, importantly. Family protection trust we talked about, and then we've got a testamentary trust. So we already know what this is. A testamentary trust is a trust that is created out of the will, as Cass said. So you've got to get to probate, then you build a trust. So the trust is going to look exactly the same as this. So they've all got the same fundamentals. They've just got different names. So here it's actually should be testamentary trust appointor 2, 3, and then we split it amongst children. But before we get there, we need to make sure that we effectively don't have a family provision claim. We don't have a promissory estoppel claim. Remember, I talked about that promise with the farmers, dad's promised the business, etc. We don't have a claim from the tax office, which might make the estate insolvent. So the testamentary trust absolutely is useful. There's some other reasons why we use it, particularly if there's minor beneficiaries, because there is some tax advantages. There's also advantages if you want to keep property. So if there's property in the estate, actually put it into a testamentary trust and maybe the family protection trust, because there's no stamp duty. But if you don't care about the property and all that, then you just cash out that family protection trust. With that one, there's a whole lot of other strategies I want to go through, but what I would suggest, it's not a bad little time to have a wee break. What I mean by have a wee break, but if you want to put up, you can see there, or just go into chat. If you've got any questions in there, just put them in, or just come off the, if you want to come off the mute, and feel free to ask me a question, because I'm going to take you to the next level. But our building block is that family protection trust, the style, which is really a multi-generational trust. One of the other ones, as I said, remember the Henry VIII, they talked about death benefits. So all the knights and all the landholders were putting everything in the trusts, because the trusts don't die, so therefore there's no death benefits. Well, I think it was in the 18th century they got around that and said, well, hold on, if you've got a trust, there's a thing called, they introduced a rule against perpetuities, which is an equitable rule, and said, look, these trusts can't go on further than 80 years, which is generally the case. So, which is no good, because here I am building it for multi-generations and it's going to go 80 years. But there is a mechanism that we use available in Australia, which it becomes perpetual, which is also another benefit, because the government has, and I saw it was, I think it was St Vincent de Paul, or one of the charities, they're both talking about this intergenerational transfer tax, because there's such a large amount of wealth sitting in the baby boomers that's going to switch hands over the next 20 or 30 years. You know what the governments are like. They can't stop getting their hands on it. So they look at promulgating that. So again, a trust is also quite beneficial for that as well. So if
Grant,
there's yep.
There is a question in the chat, but I just wanted to jump in first and just to clarify for people like myself who are brand new. So we've got a will, but what you're talking about, so there's the will, and then you're talking about the will is not necessarily a very strong instrument. So you have separately two separate trusts you've talked about tonight. There's the Family Protection Trust and the Testamentary Trust. The Family Protection Trust is where you put your crown jewels, like your intellectual property from a business, or what other assets would you put in there, versus the Testamentary Trust, which is a different trust. So you're talking about two different trusts where you would put the business operations and so on. And that's Sean's question also in the chat.
That's a really good question. And let me just go through it here. This applies on death. So this comes out of your will. So this will only come from death, whereas this one, if I just have a look at this.
You're not sharing your screen, are you?
Oh, sorry. Sorry about that. Thank you for saying that one. It's silly me. Here I am playing around. Anyway, it's not too bad, so you're going to get it anyway. So here we've got the testamentary trust. So that comes out of your will. So in the will, I'll draft up and I'll say, these are your executors. Generally what I would do is I'd say, if you've got a spouse left, everything is going to go to the spouse, and then all my bloodline. So then it goes down to these children that I've got there. So I don't need to have multi-testamentary trusts. The reason, anyway, I'll explain that. So this is something that's happening on death. But one of the problems, and I'll just put this in here as well, is before, if I look there, there's death, and then I've got my trustee company. But before that, my executor might be caught up, and I'm going to do this in red, with a family provision claim. Might have promissory estoppel. Might owe the ATO money, or other creditors. So if that's the case, if I just put this down a little bit here. So if that's the case, what I've got is I've got to get to it's almost like snakes and ladders. To get to the testamentary trust, I've got to go through all this stuff first. And if this stuff works and the lawyers, charge a monster fee, I get this at the back end. But as I said before, let's say, because if I put in the will that you have to have a testamentary trust, then you do. So, for example, in that Miller and Taylor case, I could say, well, everyone has to have a testamentary trust. But there was only $80,000. So you're setting up this vehicle for like $20,000 for one of the kids and all that, because the legal fees on these claims really sopped it up. Whereas a family protection trust is, we call it an inter vivos, so that's a Latin name, but essentially that is a living trust. And so it's an amalgam, and I got the idea from one, as you can see, from the succession side. I got the idea from the royal family. The living trust is extremely popular in the US, mainly because in the US, when you pass away, again, the same in Australia, you pass away, you get your funeral, you get your death certificate, then your lawyer or administrator, so for example, let's say Mary Jane's the administrator, or I'm the administrator, we then have to go to the Supreme Court on your state and advertise for someone. Does someone want to make a claim on the estate? And so you virtually, it's like a red rag to a bull. And I remember doing my dad's probate. Once they found out, Dad passed away, they were writing to me saying, you want to make a claim on the estate? And it's going, well, no, I'm the executor. So, but they go and troll it through, and that's what lawyers do. Is like, we call it ambulance chasing, because if a no-win, no-fee lawyer gets it, and all they have to look at, just do a no-win, no-fee lawyer, and just go no-win, no-fee lawyer will, and you'll see that they have a 99% success rate. So all they have to do is find out if you've got a child, an ex-spouse, if it's in New South Wales, and one of the children is estranged, then if there's a blended family, it's a stepchild. So blended families are like, the fun. Now, I've got strategies for all of them, mainly because we see the back end, and we see people that they know that there's going to be litigation. But the problem about it is, too often or not, we see people, when it's too late, they think there's not going to, do you mean that it's not going to be any problem, but then the problem happens. What we're seeing, and particularly over the last, I'll give you an idea. So my CEO is very fit, plays, he's the manager of the Australian seniors hockey team. He's done very well. They just won the World Cup. He was 47, had a double heart attack, was clinically dead for for 20 minutes. Went to his doctor and said to the doctor, what happened? Just said, well, we're seeing a lot more of this as the COVID vaccine. So it's a contraindication. So we see a lot. What we quite often get, I had a client the other day, is what they call turbo cancer or fast-acting cancer. So someone can be tickety-boo going down the track, and we're talking about 40 years old, 35, 45, 50. Seems to be people under the age of 50, not so much over the age of 50. But then suddenly they've got a cancer. We had one, and I'll go through and actually show you. I'll go through a really good strategy for what we're going to do, and that will cover Sean's position. So we dealt with.
Sorry, Grant, I misspoke earlier. I actually meant the difference between the Family Protection Trust versus the leading member discretionary trust.
Same. It's just the name. It's just nomenclature. That's all. So
Sheena does have a question. If it was okay to ask now, or do you want to?
Yep, sure. Get going.
So Sheena said, we placed a family property into a company/unit trust split between 3 family members. Yep. Sheena is a minor shareholder in the unit trust. She's single and has 1 adult child. How will this now affect the child in her will as her sole beneficiary?
If you, what jurisdiction is Sheena from?
I don't know, Sheena. Where are you, Sheena?
Queensland.
Yeah, Queensland, you're okay. If you're New South Wales, your ex-spouse would have been able to make a claim on your estate. So the problem there, Sheena, what we want to do for that's a classic case, because there's going to be no claim on the estate. That's a classic case of using a testamentary trust. So it all just goes in there for your daughter. I'm going to go through and tell you what goes on. So we build a will. It goes in there for your daughter and then her children after that. The issue that you're going to face is that the trust is set up with yourself and your siblings. And the problem is, if you're only a minor unit holder, you're in a very poor position in terms of, they might starve you and all that, and they might end up, I see a lot of litigations of family companies and family unit trusts ending up in litigation. So hopefully, if they're all straight up, what you should really have if you've got a unit trust is a unit holders agreement. And in that one, what would normally happen is, for example, that if something happens to you, there would be an insurance policy on you that would be funded by the others, which would enable them to buy you out, which would then, the money would go into this trust. Because the units going into the trust sounds nice, but what is your daughter going to do with them if they never sell the units or never sell the property, or they don't make distributions of income? So again, I think there's probably just a couple of things there as well. And if you've got a family property as well. So just going back to what we saw before, I'll show the strategy that which is quite popular at the moment. So we had a gentleman came to us, I think it was about 3 years ago, and he had a family. Let me go through. He had a family farm, but the problem with the family farm is there was a whole lot of tyres. So anyway, he thought the good idea with the tyres, he would actually burn them and get rid of all that. But the fire caught on, burnt down his bush, and burnt down the bush of his 2 neighbours as well. And we're talking like big farms. So the first one he was sued for, and so he settled for that. Then what transpired, and he shouldn't have settled, like I'll show you the structure, I would have set him up. But what transpired, we saw him in December, and then The problem about that is if we'd left the property there, and he had just sold another property, and he got $2.5 million. So if he'd left that all in his own name, then we're stuffed, because what will happen is he's left it all in his own name and the farm for his son. And even though it was going to be in a testamentary trust to protect his son from divorce and all that, he would have to go through litigation and everything from all those people. The executor would be caught up in litigation by that other farmer who had his property burnt down. So again, it might not be these things, it might be something else. So what we did is we utilised this strategy, which we call the protector. And I'll go through this just in a bit of detail. So we've already set up the Family Protection Trust. Remember, this is a living trust. We've got our line of family protection appointors. We have all our splitting in there as well. We might be a guardian. So what we did is his $2.5 million, the first thing we did is we transferred that over to the Family Protection Trust. So that's essentially protected for him. He had some shares, so we transferred those over, but there wasn't a huge amount. There wasn't a capital gain on them, so we could transfer that over. If you got watches, etc., you can transfer those over as well. So what we do is we do a deed of gift. So much the same way you give money to charity, it's exactly the same thing. Like if I give money to charity, to Red Cross, let's say I give them $100,000, and then 3 weeks later I say, oh God, I made a mistake. I want $50,000 back. You're not going to get that back, because once you make a gift, that's it, it's gone. So the deed of gift transfers those assets or that value over. But in your properties, remember, there's tax advantages in properties, holding them. So what we do there is we don't want to transfer the property over because there'll be stamp duty, particularly here in Queensland. So what we do there is we look at the net value of the property, which is its current market value less what we owe the bank. And then that becomes that line there. If we've got 2 or 3 investment properties, remember those negatively geared ones, so we can actually transfer the wealth to the Family Protection Trust, still have the legal title in our own name, but what transpires from there is the legal title is in our own name, but there's no wealth attached to it, so that if we get sued, we haven't got anything there. Now, a couple of things around that is that gift, when it's made over that underlying equity we've got here, there is a 4-year clawback for a trustee in bankruptcy, but generally, look, I see this put in place for, I saw one the other day, someone owed a client $10 million. They went through this process, and they ended up, the liquidator didn't really want to follow them up too much, so they ended up settling it for $1 million, so 10 cents on the dollar. So that was quite amazing. And then there was another one, the same sort of thing, $5 million tax debt, which was sorted out for, I think it was $100,000. But what we want to do is, we've got all these juicy assets outside, and if there's litigation against them like that, as I said, the neighbour of the farmer could have made litigation. So what we do is, the gift that goes over, we end up lending that back. And there's a couple of steps in there for us to do, but we end up lending it back. And then that enables us to take a registered mortgage over all the properties. So the bank will be number one. When it comes around, the mortgagee will be, your Family Protection Trust will be number 2. So that ultimately, if it gets sued, then the first loan to be paid back is the bank. The second loan will be you, because we've got effectively a security over registration of a mortgage, and then the creditors get whatever's left, and that might be the tax office or whatever, and that's why the tax office settles for such a small amount. For the watches, they'll already be in there, but if you've got company shares outside, and we're transferring company shares or asset, then what we do is we put a security deed over it, again, just to make sure that we've got the highest level of security on. So that's called the protector. So that's that. If I go back here and I know that there's a family provision claim, then what I'm going to do, or I'm in a business, what I'm going to do here, sorry, I'll just get rid of this, can't do it. What I'm going to do is, rather than have to wait for all this disaster to happen, what I'm going to do there is I'll put in place the protector, which is a living trust now. I'll transfer the wealth over there and then take security over those assets. So if you've got a blended family, then what we do is, which is one of the strategies I use, is essentially we might have not one family protection trust, we might have two. So if you've got the two spouses, we can equalise it between the different families there. And honestly, that is the only solution I know how to ensure there's not going to be any litigation, because the first thing that happens is that the executor and the administrator have to pay off all tax debts and loans, but they paid off secured loans to start off with. So ideally, when we come around to having our estate, it'd be perfect that we've virtually got nothing in our estate, so that the lawyers aren't going to work for nothing. No lawyer works for nothing, so that's the case.
So, Grant, can I just clarify? So what you're saying is that even if we do have assets in our own name,
Yep.
through your protector mechanism, we can transfer the value of those assets into the protector, the trust.
Correct.
So that when the litigators go sniffing around and looking for value in estates, it will look like my estate name has no value in it.
Correct. So what they'll do is they'll have a look. So the first thing you do, if you're in litigation, and they teach this, it's just the first thing, rule of litigation 101. I go and have a look at whether you've got a self-managed super fund. That's easy. I just look at SMSF lookup. That doesn't help if I'm litigating, and it helps if it's family law, because superannuation is matrimonial property. If you're in New South Wales, it also helps for family provision claim, but only New South Wales. That's why self-managed super funds are still the best vehicle, as far as I'm concerned. But the next stage is we then go to land titles, and then we'll find out what we can do a search on your name to find out where what land is owned by you. And the first thing you're going to look at is who it's mortgaged to. So it might be a bank, and then it might be, the Mary Jane Family Protection Trust. So once we do that, then we need to do a deposition to find out how much wealth is actually left in there. And if there's nothing, because there's no such thing as a no-win, no-fee lawyer, because what generally happens is they'll put you on the clock, and it's quite a heavy clock that they put you on, and then they rack up the fees. So when there's a settlement, they can then present their bill and say, okay, well, this is what the case is. And that's why you see when you do your no-win, no-fee lawyer research, it's always 99% success rate, because they're not going to take a difficult case.
So, Grant, do you have, so let's say an average Australian estate what's the average value these days of a normal mum and dad? Maybe $2 million more?
Yeah, it's hard to say. As I said, look, if you went to that 2013 Miller and Taylor, I put in place the protector for someone it was a divorcee, and she only had $160,000, but she knew that she had a son and a daughter. She knew that her daughter was going to make a claim on the estate, so she wanted to make sure her son got the money. So, but then I've done work the other day $4 or $5 million. The issue, I think, if you went back maybe 30 years ago, is that our estates were quite small because the home prices were very small. And then what's transpired is the uptick in the underlying value of property, superannuation, but not so much for the older generation, but certainly the younger generation, superannuation. So suddenly, if you're living in Sydney or Melbourne or Brisbane or even up here on the Sunshine Coast, it's not untoward to say that you've got, $1 million in assets. And that, if there's to give you an idea, there's been a few cases recently with $8 million in assets in them, and the legal fees have been up around about $2 to $2.5 million.
So for a few $1,000s, putting this in protection, this sort of structure around to protect, like it's sort of like insurance for your spouse or your children or your bloodline.
Yeah.
So you're not benefiting because you'll be dead, but it's sort of like insurance to make sure that the sharks, the litigators, don't eat the estate out.
Yeah, remember, what we're doing is we're building a castle that's going to stand multi-generation. So it's not like you build it and then you throw it away next week. It's the same as a self-managed super fund. Like if I build you a self-managed super fund, it's going to last, forever, but you also need it to be malleable if they make changes there. So it's worthwhile. As I said, look, come and have a meeting with me. There's no cost on the meeting. So everyone who comes to the meeting gets a book, which is a bit of a bonus, and just make a session with Mary Jane. I've got Sheena. Oh, yeah, we talked about Sheena one. So Sheena is probably worthwhile. Okay, so yeah, I think Sheena. I've got Janelle as a single person without children. Hope to one day. Is it still worthwhile creating a trust to protect my assets? Janelle, that's a really good issue. I would say no. So I'll do a couple of things. I would say no, but if you've got your beneficiaries being nieces and nephews, what I would do is I would do that testamentary trust, and your nieces and nephews can't make a claim on the estate. But what we do is, remember how we had that C1, C2, C3? You put the money in there for those children, so you don't need to set up a trust now. Virtually everyone who is, if you're in business, you definitely need to have a trust. I mean, that's vital, particularly with aggressive tax offers at the moment. But if you don't, if you're just a salary and wage earner, then what we can do is we can cover you quite easily, Janelle, with a will and a testamentary trust, but we want to put in those divisions for your nieces and nephews. We don't want to just give. So I can give you another example. My daughter's 26. She's got a really good friend, Sophie. In fact, it's very sad, extremely sad actually. So she used to come snowboarding with us all the time. Her grandmother gave her a property down in Brighton in Melbourne. She was only young, 25. The property's worth $2 million. So that was fantastic. Good old grandma. You'd be pretty happy about that one. In fact, a lot more parents and grandparents are looking at, helping out the children and grandchildren. Anyway, her boyfriend of 4 years, who'd been living with her, up and got a family lawyer, someone had obviously worded him up. And under family law, if you've lived with someone for 2 years, then all the assets you have are matrimonial property, including inheritances as well, unless you've done a binding financial agreement beforehand. Anyway, so she lost her boyfriend, lost the house, had to pay him $900,000, $150,000 in legal fees. And then I hadn't seen him for a while and asked my daughter, because I was down my daughter's engagement party last week. And now the poor thing is too frightened to go out of the house anymore. So her mental health is, as you can imagine, the stress and all that at that age. So I said, have you seen Sophie at all? She said, no, we haven't seen her for 6 months. She just won't leave the house. And that's silly because all we had to do is grandma could have set up one of those living trusts, a family protection trust, and lent the money to her. She could have had the property. The family lawyer would have gone through and said, well, hold on, buddy. She owns the title, but she doesn't own any wealth in it, and that would have cost the boyfriend maybe $5,000 or $6,000 in legal fees, and the boyfriend would have been sent packing. So it just shows you it's almost like, I remember that movie Sliding Doors. It's like, well, we could either go down this way or we could go down this way, and one can be a disaster.
So that's a great illustration of how this topic is not actually just relevant to old people like me. It's actually more relevant to the young people who are looking at their parents and their grandparents' inheritances. So to do what Cass was talking about right at the beginning, which is actually, mum and dad might not sort of be wanting to think about this or think they've got it sorted, and not be availed of the most recent up-to-date information about what's going on in the litigation world. So if you are, if you've got older members of the family, you might want to just sort of bring them into the lounge room and have a chat.
And as I said again, the best thing to do is also, if you're a business owner, it's worthwhile having a chat with me, because I do, I've started up maybe 10 or 15 businesses. So I've got about 3 or 4 on the go at the moment. So I know how to set up a business. I know how to start it up. I know how to help you get capital and all of that, and how to really protect it, which is the main thing, because I see a lot of businesses set up so poorly. And look, I believe, people should have their own business, because with the stuff, I can tell you, I'm at the forefront of AI. The stuff that's coming down the pipe is pretty scary. It's now getting a stage where AI is almost as smart as me. So that's a bit. I test it out all the time. So I tested out with some really hard SMSF problems, and it's getting around about 80%. I'll always be smarter, because I'm building an AI tool on around self-managed super funds, where all it is all the information. I've written more than 2 million words, 5 books on it, doing my 6th book. So that just sits in this library, and then I put all the ATO rulings in the library. All the audit standards from SMSF auditors are in the library. So the only things I know are true are in that library, and then I prevent it going outside into the web. So that's like, it becomes a verified source. So that's useful, but suddenly all these people used to get money for doing SMSF advice. So I've effectively cloned myself. So watch out.
People still like to talk to real people, Grant. So
absolutely.
The real people at the front end can certainly use your tool.
Absolutely.
Because you can't just Google these things, or even AI general search. You've got to use a specialized tool.
You need a specialized tool, as I said, because even with the deep reasoning ones, the deep thinking ones, you can actually see it going out to all the internet sites and the web, and the problem about that is, if that's rubbish, then, do you know what I mean? Which it is generally. Some of the answers I get back are pretty tough, but yeah. But anyway, look, if you guys, I'll go and have a bite to eat and batten down the hatches for, hopefully the cyclone doesn't hit too hard here. And well, lovely meeting you all. Get a copy of the book. Make an appointment if you want. As I said, there's no cost to the appointment at this stage, but as this takes off, obviously it'll be down the track. But let's go ahead, and you've got a good team with Cass and Mary Jane. I'm actually doing her stuff as well at the moment. So the good thing is I've done it, Mary Jane's done it, Cass has done it. So you know, we're all we're all doing it for a reason. So again, love to help you.
Yeah.
Anyway, that's enough for me. So thanks
Thank
for
you
your
so
time,
much,
guys.
Grant. Thanks everyone for joining. This video will be available on our website tomorrow, I hope. Thanks very much, and send in questions or email me with any follow-ups that you've got. Okay. Thanks. Bye.